Hey there, fellow investors and anyone who's ever looked at a stock quote, ever wonder how companies tell their financial stories? It's called financial reporting, and it's kind of a big deal. Think of it like this. Imagine trying to pick a restaurant without a menu. You'd have no idea what they serve, how much it costs, or if you're about to get food poisoning. Not ideal, right? That's where financial reporting comes in. It's how companies tell the world about their money, how much they made, how much they spent, and what they're worth. But here's the catch. Without rules, companies could basically lie their pants off. They could inflate their earnings, hide their debts, and generally pull the wool over everyone's eyes. This isn't just some abstract accounting problem. Remember Enron? That energy giant cooked its books so badly it went bankrupt overnight, costing investors billions and shaking Wall Street to its core. And let's not forget WorldCom, another accounting scandal that cost investors a fortune. These scandals prove one thing: we need rules in financial reporting. Without them, it's a free-for-all and nobody wins except the crooks. Enter regulatory frameworks, the unsung heroes of the financial world. So, who writes these financial reporting rules? Meet the accounting standard setters, the rule makers of the financial world. Two big names dominate the scene: the International Financial Reporting Standards, or IFAS, and the Generally Accepted Accounting Principles, or GAD or WAP. Think of them as the referees of financial reporting, making sure everyone plays by the same rules. The IFRS is like the United Nations of Accounting Standards. It's used in over 140 countries, aiming to create a single set of high-quality, globally accepted accounting standards. GAAP, on the other hand, is the homegrown hero of the United States, setting the accounting rules for American companies. While both systems aim for transparency and accuracy, they have their differences. It's like choosing between watching football and rugby. Both involve a ball and scoring, but the rules and strategies are different. Now, you might be wondering, why bother with all these rules? Isn't it easier to let companies report however they want? Here's the thing: standardized accounting is like speaking the same language in the business world. It ensures that everyone is on the same page, making financial statements easier to understand and compare. Imagine trying to compare the financial health of a tech startup in Silicon Valley with a century-old manufacturing giant in the Midwest. Without a common set of accounting standards, it would be like comparing apples and oranges, a recipe for confusion and bad investment decisions. Standardized accounting creates a level playing field, allowing investors to make informed decisions based on reliable and comparable financial information. It's like having a universal translator for financial statements, making it easier to invest wisely, no matter where a company is based or what industry it's in. When it comes to setting accounting standards, there are two main approaches: principles-based and rules-based. Think of it like baking a cake. A principles-based approach would be like giving you a general recipe. Combine flour, sugar, eggs, and butter. It outlines the broad objectives but leaves room for interpretation and judgment based on your specific cake. A rules-based approach, on the other hand, would be like giving you a super detailed recipe with precise measurements and step-by-step instructions. It leaves less room for interpretation, but can be rigid and complex. IFRS leans more towards principles-based accounting, focusing on the spirit of the rules and allowing for professional judgment. GAAP, while evolving, has historically been more rules-based, emphasizing detailed guidance and specific procedures. Section 5. Transparency time, shining a light on corporate finances. Transparency is the name of the game in financial reporting. It's about companies being open and honest about their financial performance, good or bad. Think of it like this: would you buy a used car without looking under the hood? Probably not. Transparency is essential for investors to make informed decisions. It allows them to assess a company's financial health, understand its risks, and evaluate its long-term prospects. Without transparency, investors are left in the dark, vulnerable to manipulation and fraud. Regulatory frameworks promote transparency by requiring companies to disclose comprehensive and accurate financial information. This includes not just the good stuff, but also the bad and the ugly potential risks, liabilities, and anything else that could impact an investor's decision. Section 6. Comparability counts. Comparing apples to apples in the market. Remember that fruit salad analogy from earlier? Well, comparability is key in financial reporting. It's about ensuring that companies are using the same accounting methods and principles so investors can compare their performance fairly. Imagine trying to compare the profitability of two companies, one using a straight-line depreciation method and the other using an accelerated method. Without consistent accounting methods, it's like comparing a lion to a house cat. They're both felines, but their size and ferocity are vastly different. Regulatory frameworks promote comparability by establishing common accounting standards and principles. This allows investors to make apples-to-apples comparisons between companies, even if they operate in different industries or geographic locations. Section 7. Catch me if you can how regulations fight financial fraud. Let's be real. Some people will always try to game the system. Financial reporting is no exception. That's where regulations come in, acting as a deterrent and a detection mechanism for financial shenanigans. Think of financial regulations as the security guards of the financial world, patrolling for suspicious activity and apprehending the bad guys. They establish rules and procedures to prevent fraud, detect irregularities, and hold companies accountable for their actions. The Sarbanes-Oxley Act of 2002, enacted in response to the Enron and WorldCom scandals, is a prime example of regulation stepping up to the plate. It strengthened accounting regulations, increased corporate governance requirements, and enhanced financial reporting transparency. Section 8. Sarbanes-Oxley, the Post-Enron World. Remember Enron? The poster child for corporate greed and accounting fraud? Well, their spectacular collapse sent shockwaves through the financial world, leading to the creation of the Sarbanes-Oxley Act, or SOX. SOX was like the financial world hitting the reset button. It brought in stricter rules for auditing, corporate governance, and financial reporting. Think of it as a much-needed dose of accountability for companies and their executives. One of SOX's key provisions is the establishment of the Public Company Accounting Oversight Board, or PCAOB, an independent body that oversees the audits of public companies. It's like having a watchdog for the watchdogs, ensuring that audits are conducted with integrity and independence. Section 9. The never-ending story, why financial regulations must evolve. The financial world is constantly changing. New technologies emerge, business models evolve, and the global economy throws curveballs our way. Financial regulations can't afford to be static. They need to adapt to keep pace with these changes. Think of it like updating your phone's operating system. Just like those updates patch security vulnerabilities and improve performance, regulatory updates address emerging risks, close loopholes, and ensure that financial reporting remains relevant and reliable. The rise of cryptocurrencies and decentralized finance, or DeFi, is a prime example of why regulatory evolution is crucial. These new technologies present both opportunities and challenges, and regulators are working to develop frameworks that foster innovation while mitigating risks. Section 10. Wrapping it up, trust, transparency, and the future of finance. At its core, financial reporting is all about trust. Investors need to trust that the information they're getting from companies is accurate, reliable, and comparable. Regulatory frameworks provide the foundation for that trust, ensuring that everyone is playing by the same rules and that the playing field is level. Transparency and comparability are the cornerstones of a well-functioning financial market. They allow investors to make informed decisions, promote fair competition, and foster economic growth. As the financial world continues to evolve, so too must our regulatory frameworks. By embracing innovation, adapting to change, and prioritizing investor protection, we can ensure that financial reporting remains a reliable compass guiding us towards a more stable and prosperous future.